If you've ever looked at a stock chart and felt completely lost, you're not alone. At first glance, it looks like a mess of visual noise, just a line thrashing around the screen with no rhyme or reason. But there is a logic hidden in that movement. Every single zigzag is the result of a continuous, real-time tug-of-war between two groups of people, the buyers and the sellers. To see it, let's simplify the chart. Imagine a room where the price of a stock is a rubber ball bouncing between the floor and the ceiling. When the ball hits the floor, it bounces back up. In trading, we call this support. It's a price level where buyers decide the stock is a bargain. They step in, start buying, and that collective demand stops the price from falling any further. When the ball hits the ceiling, it's pushed back down. This is resistance. This is the level where sellers decide the stock is getting too expensive. They sell their positions to take a profit, and that selling pressure creates a roof the price can't quite break through. Every trader in the world is trying to find these boundaries. Once you can spot the floor and the ceiling, you can see the hidden room where the price is actually living. It feels like magic, but these lines hold weight because of human memory and regret. Imagine you see a stock at $50. You think about buying it, but you wait. Suddenly, the price jumps to $55. You feel that sting of a missed opportunity, and you tell yourself, if it ever hits 50 again, I'm not missing out this time. You aren't the only one feeling that. There are thousands of other people, some who missed the boat and others who sold too early, all waiting for a second chance at $50. When the price dips back to 50, those combined orders create a massive wall of demand that physically forces the price back up. Support and resistance levels are the physical fingerprints of our shared psychology. They show us exactly where the crowd is most likely to change its mind. In a growing market, the price climbs, creating a staircase pattern with higher highs and higher lows. When buyers smash through an old ceiling, it's a break of structure, signaling the upward trend is continuing. This leads to one of the most important rules in trading. Once you break through a ceiling and stand firmly on top of it, it becomes your new floor. On this real-world chart of the British pound, the top horizontal line acts as a ceiling twice. But once the price finally breaks through, it comes back to rest on that same line, using it as a new floor. This is how the market moves with intention. It builds itself one step at a time, turning old obstacles into new foundations. To stay safe, you also have to know when that staircase is about to collapse. If the price stops making new peaks and instead crashes down through its most recent floor, the character of the market has changed. This is a warning sign that the staircase is ending and a reversal is starting. This break is your first signal that the buyers, the team that was pushing the ball up, have lost control and the sellers have taken over. You can see this shift in the individual candles. A green candle is bullish, like a bull tossing its horns up, meaning the price closed higher than it opened. A red candle is bearish, like a bear swiping down, showing sellers pulled the price lower. Look at this chart for Pfizer. Despite the messy volume bars at the bottom, the logic holds. Those red lines show exactly where buyers created a floor and sellers created a ceiling. The day-to-day chaos is actually contained within a very specific room. Those erratic zigzags from the beginning now reveal a clear, logic-driven path. You can look at any chart, find the invisible staircase, and see exactly who is currently winning the game.